Hi, my name's Adam Boatsman, Managing Partner, BGW CPA, and I want to talk to you today about one of the most commonly overlooked tax deductions that we find when we start working with a new client, and that's that they have an asset that they are not utilizing as a tax deduction. I'm talking to you from my own vacation place in Ocean Isle, North Carolina, because of BGW CPA. I like to eat from the dog food that I'm preaching. So here we go. How do I get a tax deduction for a beach place? Well, if you ever read the book Rich Dad Poor Dad by Robert Kiyosaki, this is what he's talking about. How do I have assets that I can convert into income producing property? Which getting a tax deduction for something that you otherwise weren't getting a tax deduction for and saving money on taxes is in fact income producing. A lot of people get concerned though. They think, man, isn't that aggressive? Am I going to get audited for this stuff? No. The ability to have a second home is actually embedded within the tax code. So there's two ways that you can get a tax deduction. Way number one follows what's called the Augusta rule, which is anybody has the ability to rent their home for up to 14 days without claiming into the income. Now, there's some rules around this in terms of how long you can stay in the house and all that kind of stuff. But at the end of the day, what I would say is, well, wait a second. Am I really staying in the home for vacation purposes? Or if you're like me, I'm getting some work done. Anyway, so when you think about, well, where does the 14 days of rental income come from? It comes from your business. That's how you get the tax deduction. Now, you might say, geez, what am I going to rent my own house for? Strategic planning retreat. I don't know. I came up with the idea for this video while staying in my place. Was I really vacationing or was I really working? A lot of people get hung up on, is something aggressive or not? But what I think about is, look, if a Fortune 500 company can do it, why can't I do it? And in the case of a strategic planning retreat, think about what Fortune 500 companies do. They get all their executives together. They fly them to first-class destinations, put them up, wine them and dine them. In Hawaii, Salesforce, as an example, have Metallica playing at their company retreat. If that's a tax deduction, then why can't my vacation place that I'm doing a strategic planning retreat on also be a tax deduction? So that's one simple way to do it. The other way to do it is similar concept, but if you already have an active rental property, which, my place also rents out on VRBO, so if you want to rent it, look it up. It's called Got It Together. But anyway, if you're already renting it out anyway, just be another one of your own tenants and pay yourself. Again, easy way to get a tax deduction for something that you've already got and you're paying for anyway. So hope this helps. If you want to learn more about this technique and all the other techniques that we subscribe to at BGW CPA, then go ahead and take a look at the Vault, which is in a link below. It's got all of our best tax planning ideas and also ideas around cash flow, succession planning, and pretty much anything else that you need to know as a business owner.